The Kelly Criterion is a famous mathematical formula that attempts to maximize your long-term capital growth. Let's apply it to a euro-dollar breakout strategy and see how it performs.
The Kelly Criterion is used to determine the optimal position size that will maximize your strategy's long-term returns. Here's how it's calculated. F is the fraction of your account to risk per trade. P is your strategy's win rate and varies from 0 to 1. B is the average win divided by the average loss. For example, if your strategy contains a $10 stop loss and a $10 profit target, B will be 1. If you raise your profit target to $20 without moving your stop loss, B will be 2. The values of P and B can be obtained from your MT4 backtest report. So if you have an equal stop loss and profit target and a 60% win rate, the Kelly Criterion recommends that you risk 20% of your capital per trade. If your strategy's expectancy, or average trade, is 0, the Kelly Criterion wisely gives you a position size of 0. To evaluate the usefulness of the Kelly Criterion, I'll apply it to a 15-minute euro-dollar strategy. It uses the CCI indicator to detect breakouts, and has a 150 pip stop loss and profit target. When trading a fixed 0.1 lots throughout the backtest, the strategy yields a pleasant equity curve from 2003 to 2021. Now let's apply the Kelly Criterion. With a win rate of 57%, the Kelly Criterion tells me I should risk 14% of my account per trade. Let's rerun the backtest with this number. Returns are spectacular. After only 587 trades, my account grew from $5,000 to $210,000, a 4,100% return. Returns are only part of the equation though. Unfortunately, with an 8-trade losing streak, the strategy had a whopping 71% maximum drawdown. With such a drawdown, you'll need 250% returns just to break even. This is the price to pay if you're after massive returns. It's easy to overestimate the amount of drawdown you can tolerate in real time. To make the strategy tradable, I'll need to lower the strategy's drawdown by risking a smaller fraction of capital per trade. I varied the fraction of account risked from 1 to 8%, as shown. If I were to trade this strategy in isolation, I wouldn't risk more than 4% per trade, which produces a 27% maximum drawdown. At this risk level, the strategy still achieved a 9% annual return over 18 years. Nothing like the Kelly returns, but at least I won't lose sleep at night. If you're hungry for better performance, a prudent option will be to trade a portfolio of uncorrelated strategies. Returns are additive, but drawdowns are not, thus giving you better risk-adjusted performance. There are 2 reasons why I believe the Kelly Criterion should remain in the realm of gambling. Firstly, it does not consider risk. From the example above, you can see the Kelly betting fraction tends to produce huge drawdowns. This is because its sole purpose is to maximize your long-term returns, without taking drawdown into consideration. Drawdowns above 50% would be unbearable for the majority of traders. Backtests offer the benefit of hindsight. In reality, you'll have to trade through the drawdowns without knowing whether your account will recover. For the backtest above, I got lucky because the strategy performed fairly consistently over time. If my losing streak had been longer than 8 trades, the 14% position size could have resulted in a margin call. Secondly, the Kelly Criterion only applies to binomial outputs. Every trade needs to result in either a win or a loss, and your win and loss amounts need to be fixed. If you use a fixed stop loss and profit target for your strategy, like the euro-dollar strategy above, this won't be a problem. But if your trade management includes trailing stops, time stops, or indicator-based exits, you won't know your win or loss amount in advance. For example, if you're a long-term trend follower who lets your profits run, your winning trades could be anywhere from 1 to 1,000 pips. Consider the trade distribution below, taken from a trend-following strategy. The Kelly Criterion cannot meaningfully analyze such a distribution, which severely limits its usefulness in trading. So the Kelly Criterion is an aggressive position sizing method that serves to maximize your long-term returns, without taking drawdowns into consideration. Most traders will likely find the Kelly-induced drawdowns to be unbearable. I can only recommend the Kelly Criterion if you're taking part in a trading contest, or going for broke in the short term. Sticking with conventional fixed fractional position sizing, and risking no more than 3% of capital per trade, will improve your odds of long-term survival. Please support the channel by liking and subscribing. See you at the next video.